Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Intel was once the clear leader in the chip industry, dominating the market with their innovative technology and strong reputation. However, in recent years, they have faced significant challenges from competitors who have caught up and even surpassed them in some areas. This presentation will explore the critical strategic mistake Intel made that led to this shift and how it cost them their near dominance in the industry. As you can see from these images, Intel's brand and technology have been central to computer hardware for decades, but that strong position has been challenged by changes in the market and strategy. Let's dive in to understand what happened. For a long time, Intel was the dominant force in semiconductors. Their control of the x86 standard, ownership of manufacturing, and ability to set performance goals made Intel inside more than just a slogan. It was a reality. But that position has changed. AMD now leads in performance discussions, NVIDIA drives the future of AI, and TSMC excels in manufacturing. Intel is no longer the clear leader and is now in a difficult position, cutting costs, pausing dividends, laying off workers, and asking for government assistance to help turn around its fortunes. This decline didn't happen suddenly or because of a single failure. Instead, it was the result of a long-term strategic mistake. Over 15 years, Intel spent over $100 billion on share buybacks and dividends, focusing on rewarding shareholders while underfunding the key areas that built its competitive edge: process innovation, manufacturing, and architecture. We'll look closely at this $100 billion error, explore the lessons it offers for business leaders, and understand how focusing on short-term financial gains can quietly erode a company's long-term strength. At its peak, Intel held a dominant position in the CPU market, backed by three key strengths: advanced manufacturing capabilities that outpaced competitors, a superior processor architecture known for performance and energy efficiency, and the benefits of scale that allowed for high profit margins and continuous reinvestment. The critical issue wasn't that Intel stopped investing in research and development, but rather how they chose to allocate their additional capital. Between 2005 and 2020, Intel spent roughly $108 billion on buying back shares, often paying more than the current market value, while also maintaining a steady dividend to satisfy investors. Although buybacks and dividends are normal, especially in mature companies, in a technology-driven and capital-intensive industry like semiconductors, the priority should be on reinvesting in innovation and manufacturing upgrades. Leadership in this sector isn't guaranteed. It must be earned anew with each technological generation. Unfortunately, Intel shifted too much capital toward buybacks and dividends, rather than aggressively funding the continuous improvements necessary, which ultimately weakened their competitive edge. Intel's long-standing edge in manufacturing began to crumble with significant delays in developing their 10 nanometers process, forcing them to stick with aging 14 nanometers technology. Meanwhile, competitors like AMD moved ahead using TSMC's more advanced 7 nanometers nodes. Intel admitted they set overly ambitious technical goals and struggled to execute, breaking the reliable tick-tock product cycle that had defined the industry for years. This misstep allowed AMD to surpass Intel in performance per watt, which in turn eroded Intel's pricing power and gave customers a viable alternative for the first time in decades. The market share shifts tell the story. AMD's share of desktop CPUs grew dramatically from near insignificance in the mid-2010s to over 32% by 2025, while Intel's dominance shrank from nearly a 9, one lead to about 2. In the server market, Intel's primary profit source, AMD's progress is even more striking, capturing over 27% of units and about 41% of revenue, marking a huge reversal of Intel's previous near monopoly. This wasn't just about missing a product launch timeline. It reflected years of underinvestment in delivering on manufacturing capabilities, with the problem masked by continued payouts to shareholders rather than reinvesting in the future. The story of Intel offers valuable lessons that go beyond just the semiconductor industry. First, Capital allocation isn't just a financial policy, it's a core part strategy. Every dollar given back to shareholders means less money that could be reinvested to build future capabilities. Intel's experience shows that even companies with strong market positions can lose their edge if they prioritize short-term returns over long-term investment. Second, monopoly profits can create a false sense of security. Intel's long dominance made buybacks feel safe because cash flow was strong, but this confidence prevented them from recognizing how fragile their position really was. When their manufacturing lead disappeared, their entire business model suffered, leading to price cuts and shrinking margins. Lastly, financial engineering can't replace technical execution. Intel didn't fail for lack of money. They simply allocated it poorly. They still spend more on research and development than competitors like AMD and NVIDIA, yet struggle to turn that investment into meaningful results. Rebuilding lost technical strength is far more difficult than maintaining it, and that's a key takeaway for any business facing similar challenges. The first step is to rank capital priorities honestly. In industries like deep tech, protecting and expanding your core strengths should come first. Next, you fund the next generation of capabilities, and after that, you make sure your balance sheet stays strong. Only after these priorities are covered should you think about returning capital to shareholders. Intel, unfortunately, reversed this order for years. Second, dividends should be seen as optional, not guaranteed. Intel kept paying dividends even as their competitive position weakened, which made their financial situation rigid and less able to support innovation. Third, focus on opportunity cost rather than just earnings per share. Share buybacks can artificially boost EPs, but if this growth isn't backed by actual improvements in capability, it's misleading. Intel's strong EPs numbers disguised a weakening manufacturing base. Lastly, invest proactively, not reactively. Intel's recent multi-billion-dollar spending on foundries and restructuring is necessary, but it's catch-up spending, not leadership investment. The key lesson is to allocate capital with a clear strategic focus, prioritizing long-term innovation and resilience over short-term financial optics. Looking at the real-life comparisons, Intel and AMD illustrate two very different strategies. Intel has spent over $100 billion on buybacks, but at the same time, they face delays in advancing their manufacturing nodes and their profit margins have been shrinking. On the other hand, AMD has focused heavily on research and development while adopting a fabless model, partnering with TSMC for manufacturing. This approach has helped AMD grow its market share and improve its pricing power. When we compare Intel and NVIDIA, the gap is even more evident. Intel largely missed the wave of AI acceleration, whereas NVIDIA made significant investments in software, GPUs, and building a broad ecosystem. This reinvestment in R&D has allowed NVIDIA to achieve a near monopoly position in AI acceleration, turning its technology leadership into a strong competitive advantage. These examples show how important it is to allocate capital wisely, not just for immediate gains, but for sustaining long-term innovation and leadership. In the short term, Intel's strategy of paying out higher earnings per share and increasing shareholder dividends and buybacks helped to support the stock price, especially during periods when growth was flat. This approach also satisfied investors who were focused on income from dividends rather than long-term company growth. However, the long-term consequences were significant. Intel lost its manufacturing leadership, which had been a core competitive advantage. This allowed competitors like AMD, NVIDIA, and ARM to gain ground, breaking Intel's monopoly pricing power. As a result, Intel was forced into costly and risky investments to try and catch up. Ultimately, these moves destroyed more shareholder value than the short-term payouts returned, illustrating how prioritizing immediate returns damaged the company's future position in the market. Intel's failure wasn't a result of greed or incompetence, but rather a rational choice made too often in the short term. By consistently prioritizing dividends and buybacks instead of reinvesting in innovation, Intel gradually weakened the very foundation of its market leadership. When the industry moved toward newer technologies like advanced nodes, power efficiency, and AI, Intel no longer had the capability to keep up. As a result, its monopoly disappeared, margins shrank, and the company that once set the standard in computing now struggles to maintain its relevance. For business leaders, the lesson is clear. You can't solve technological decline through financial engineering alone. How you allocate capital shapes your future. Intel chose to reward shareholders in the present, while its competitors invested in the future. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.